And welcome to Phil's Gang YouTube channel. Okay, I want to explain the market and what's going to happen with it. But first of all, with the crash. But first of all, I want to explain to you what's going on with gold. Okay, because gold has been going up like this, and then all of a sudden gold has stopped going up. Gold, especially gold mining stocks, and now gold mining stocks have turned, and now they've dropped, and they keep dropping almost every day. So gold is going down, mining stocks. And here's the curious one: is the dollar, because the dollar is going down, and you can see it right over here. And the dollar is going down, and if the dollar's going down, that's usually good news for gold. Because when the dollar goes down, gold tends to go up, but it's going down. So you got the dollar going down, you got gold going down. And guess what else we have going down, which is unusual at the same time, is oil. That's right. So oil is going down. And oil has been going up. And then same thing. She turned around and she too is having problems, and oil is turning and going down. Now, we all know that this doesn't make any sense, because when the dollar goes up, the gold and the oil go down. Okay, when the dollar goes down, oil and gold goes up. But see, they're not. So now what we have is this. What's causing this is the yields on the 10-year Treasury right here. It's the yield on the 10-year Treasury. Okay, the yields on the 10-year Treasury since last week has gone from about 1.6 up to January to 2.4 last week to now it's 2.27. So what's going on? Well, when yields go up, that's interest rates. Yields are interest. And the government borrows money, okay, and the amount of interest that they borrow is tied to the Treasury. So whatever this 10-year Treasury is what the government has to pay for money. So, and you have, and when that happens, they can't pay 2.4, 2.7%. And that's what they're paying right now. And the Chinese love it, because it's the Chinese right now who, what they do is they take and print their money, their yuan. They print their yuan, and then they buy dollars. And what they've been doing is giving the dollars to the Treasury. And they're happy because the Treasury gives them 2.4%. So they're very happy about that. So the same thing with the Saudis. Anybody who has our dollars, okay, is getting 2.4%. Now, the problem is the stock market has done this. The stock market has gone up like this, and it's stopped dead in its tracks while the economy is going down. So you got the stock market going up, and the stock market is in this consolidation for months now, and it's having a hard time breaking out of this consolidation. And every week we're either up, we go up to the top, we come back to the bottom, up to the top, back to the bottom. This is what's going on. It's in the consolidation. In fact, what's interesting is the consolidation is about 4% the range. Now it's even getting smaller than that. It's about 2.5%. So the market can't go up or break out because the yields are too high. And when the yields are too high or interest is too high, that means sends a message the economy isn't doing good. So the stock market starts selling off. And that's what's going on. So you got the market selling off, or it's inside this consolidation. So we got to fix all this. Now there's a real problem, because we're finding now that because these interest rates are so high, that we're going to have to buy oil, a lot of oil, because what's going on is we have stopped. The EPA and all the rules that come in from Obama has stopped a lot of the oil fracking, and a lot of the oil investment going into fracking is dried up. So that means we're not producing the fracking, the oil that we once did. So we got to go over and buy the oil now. That means we got to ship this oil. We got to take and ship this oil back now. Okay, we got to ship this oil back to our country, and that's expensive. So who's going to pay for this oil back to the United States? So the government's got to pay for it. Where are they going to get their money from? Well, they got to borrow it. Well, what rate? 2.4%. Well, that's crazy. So we got to, this fall, when winter comes, we got to buy all this oil because our fracking is down. That's all because of what Obama did with the EPA and killing our fracking and our investments. So now they're going to ship oil to the United States. So they got to buy it. So how are they going to buy it? They got to borrow. What determines the interest rate when the government borrows money? The 10-year Treasury right here. So what's going to have to happen? They got to get this rate down to 1.6. How do they do that? It's called quantitative easing. So what they do is they bring in the printing machine right here, and they'll print all this money. They'll print these dollars. Okay, they print all these dollars, and they're going to take these dollars, and they're going to go in and buy at auction. This is the Treasury. Yellen's going to go and print all these dollars, and then she's going to buy at auction all these 10-year Treasuries from the Treasury Department. The 10-year right here. She's going to go in and bid on them, and then she's going to bring this rate down from 2.4. She's going to try to drop that rate down to 2.7 to 1.6. And doing that, the government now is going to borrow at a better rate. And now with all this printing of money, what's going to happen? Now the stock market is going to turn, and it's going to run right back up, just like it has been on quantitative easing. Because when Yellen borrows all this money, prints the money and buys these 10-year treasuries, and the yield drops, the Chinese and the Saudis no longer buy treasuries. They come over here, and they rather buy the stock. So the Chinese and the Saudis, we'll just put S for the Saudis, they're going to come over here and they're going to buy the treasury, buy the stock market. That's what moves the market up without earnings, without sales. So that's how we got our 30% gain every year for 5 years. Okay, more than that, 6 years. That's how we got almost a 200% gain, because every year we kept getting a 30% increase. Why? Not because we have top line sales of companies. We don't. People don't have any money. So the way the stock market is going up is through the Saudis by us printing the money, buying the treasuries, dropping them down. Saudis and Chinese look and they say, oh no, it's not attractive anymore. I'm going to go buy stocks. Also, what do? She will also give money now to the corporations. All right. She'll give money to large corporations, and she'll give the money to the corporations, okay, at 0%. So they can buy what? So they can buy their own shares back right here. And when they buy their own shares back, okay, it's a great deal for them. Not good for the company, because the company, remember, you don't have any, there's no value. You have no value when you do that. So it's not good for the company at all. But what happens is, think of it this way here. Think of the company as, we'll call the company Joe Suckface Company. And let me put an X for Joe Suckface Company right here. So here's Joe Suckface Company. And so she's going to give Joe Suckface money at 0%, and he's going to buy his own bonds. So I mean, he's going to go and buy his own shares. Now what he does is, let's say Joe Suckface Inc. is priced at $50 a share. Okay, let's say it's $50 a share. So at $50 a share, and let's say there's 100,000 shares right here. Say there's 100,000 of them, okay, outstanding at $50 a share. So that means if you divide, okay, the 100%, divide that by the 100,000 shares, that means each share equals 0.001%. Now, management, because there's very little growth rate at the company, because nobody has any money, the people don't have any money today. So the growth rate is the same as it was last year. They netted $1 million last year, and this year they're going to net $1 million, no growth. So they get a little upset because they're afraid that the shareholders may get together and throw out management. So instead, they'll make management rich. So the very next day, the CEO decides after they have a meeting with management, they say, look, he goes, takes the $1 million out of the checking account, the money they made, and he buys 20,000 shares right here. He buys 20,000 of these shares right here, 20,000 of them. All right, 20,000 of these shares. And by buying 20,000 of those shares, now there's only 80,000 shares of the 100,000. So now there's only 80,000 of the original 100,000. So the CEO, as I said, takes the $1 million out of the bank, buys 20,000 shares. Now there's only 80,000 shares of Joe Suckface Inc. Gets to have 100. Each share you own no longer represents 0.001, no longer 0.00.1. Instead, it represents 0.125%. Now, that's equals 25%. So that's a pretty good deal. So that equals 25%. So overnight, without increasing any sales, Joe Suckface did $1 million in sales last year. It's doing $1 million now without $1 increase. The stock price overnight went from $62.50, from $50 to $62.50. So it went from $50, okay, over here to $62 overnight. But there was no sales. So even though there was no growth in the company, so you still made a 25% increase on your investment. So that's, now what about the company? How did the company make out? Nothing. Matter of fact, it's bad for the company. So what they've been doing, so this company, Joe Suckface Company, is going to keep growing and growing and growing and growing the stock value, but the company, there's no more sales. It's all a bubble. It's called a bubble. That's all a bubble. Because every time the stock goes up, it's because they cut back the amount of shares, you see? So what does this all mean? Well, what's going to happen, that's another bubble. So what's going to happen? This is all going to implode. And when will it implode? It'll implode this fall, okay? Because as the economy's getting worse, remember, the stock market has stopped going up and the economy's getting worse. Every day we're getting worse and worse financial information. So this fall, when they buy oil, that's when they're going to have to do QE4 to get the printing press out right here. You're going to do QE4 right here because we need it, because we got to print this money to get these 10-year treasury rates down, to get these people, the Saudis and the Chinese, to move into the stock market, to push the market up. And Yellen for the government needs to borrow money at 1.6, or the government would go broke. You'd go into bankruptcy. So the market then is going to just continue to go up again without any sales. So we'll just keep going up, and hopefully we go up another 200%. But before we have that, we're going to have first a drop in the stock market because of this, okay? Because we can't break out, and because the yields are so high, that's telling us the economy is getting worse. We see now the Europeans have left the market. About 42% of them have left, and they're getting out of the market. So what's going to happen? The market's going to keep going down. What they're doing right now is trying to hold the stock market up, okay? And they're doing that with the banks right now, trying to push the bank stocks up during earnings season and hold it up. So we're going to have a beautiful opportunity here. So I'd say QE4 is going to happen in this fall when they need to buy oil. And they got to buy oil because Obama has killed fracking with the EPA. We can't produce enough oil. If he didn't do that, we'd be fine, you see. But now we got to go, and we don't have enough money. So we got to print it. So that's where we stand. And that's why the PE2 chart is a wonderful thing to own, because you can see when it turns green, you buy it. When it turns red, you sell it or go short. And this has been a beautiful thing. That's a beautiful thing. So that's why you should try to get my PT2 chart, which is a beautiful thing. It shows you exactly when to buy and when to sell. And I'll give you one more stock here just so you can see it. Let's take, for example, oil service stocks, SLB. You can see after a drop, we bought SLB right here. And you can see she ran up nicely. And we took our profits when she started to turn red. And now when she turns green again, we'll buy it. Or if she keeps going down red, we'll sell it short. So it's a beautiful piece of equipment that works with this kind of mess here because there's no more fundamentals. Nobody cares about fundamentals. The longest people, even these large companies, the longest Wall Street holds a stock right now is about 60 days because they're trading them just like we are. So that's what's going on, and that's what answers your question. Why is it gold is going down, oil is going down, while the dollar is going down? Well, now you know why. Because the 10-year Treasury is going up, which supersedes the dollar. Okay? See you on the charts.